All right, we're live, Raji. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We help hedge funds, portfolio managers, RIAs, and individuals earn better returns in the equity portion of their portfolios. Back in November, we told people that we were concerned about inflation and recommended hedging by buying things like gold, silver, and oil. We're here today to talk with my old partner from Silver Arrow, a member of the Deep Knowledge Investing Board of Advisors, the portfolio manager of ArcanX, and one of the single best stock analysts and portfolio managers I've ever known, Raji Khabbaz. Raji, thanks for doing this with us today.
Thanks for having me, Gary.
All right. So Raji and I have these conversations on a nightly basis. We thought it might be nice to bring everybody else in. Today, we're going to be talking about oil, why we think oil is a good investment right now, why we've been invested in it for the past 6 or 7 months, and specifically what oil stocks we're buying. Raji's done a phenomenal amount of work in the sector. Before we get started, I just want to let everybody know, if you have questions, the chat is open. So send questions in and we'll be happy to address them. So Raji, first question, why oil? Why now? Why should anybody even be investing in oil, especially with prices where they are?
It's a great question, Gary. We started looking at oil at sort of middle of 2020. The oil industry has gone through a really difficult 10-year period. The whole move, as everybody knows, to green energy and away from sort of carbon fuel has resulted in a huge underinvestment in oil production over a decade-long period. There's been a new mantra among oil companies in terms of how they deploy capital. I mean, the old model was generate a dollar of cash flow, put it back in the ground, increase reserves and production. And that's completely changed to today, where we're seeing very little reinvestment in new production and cash flow going towards dividends and deleveraging balance sheets and buying back stock. And what's happened, interestingly, is, a unique period of history where oil prices have gone up dramatically. But drilling activity and production activity, at least among the Western oil companies, has not moved very much. In fact, there was just a report recently that U.S. oil production was down year over year. And we've seen that develop, through the low rig counts all year and really just following the companies. And then you look at what's going on with OPEC, and they continue to underproduce their quota targets. And we've got ourselves in a situation where we've got this multi-year, almost decade-long deficit in spending. And at the same time, oil demand has come back. And that has set the stage for the real sharp rise in oil prices. And, the continued lack in investment is exacerbating a really dire supply and inventory situation. We just sort of came through the first quarter season when typically it's a low demand season and refineries go offline and inventories build into the peak late spring, summer driving travel season. And the opposite has happened, actually. Inventories are below 5-year averages, and we head into a peak period where, there's going to be some real scary shortages. We're seeing in diesel and jet fuel right now across the states. And the nature of oil is these are long tail investment projects. You can't bring it on that quickly. 12 to 18 months of drilling activity, and we just haven't seen that yet. We track that very closely. So, we've had a rebound in energy demand, and we've had no reinvestment, and a historically astonishing delinking of production and price action. You could look at sort of the Baker Hughes rig count and correlate it, graph it against oil prices, and they've gone two different ways. So, the supply shortages are going to be there. They're sort of dialed in for quite some time, even if the industry and OPEC and a whole host of other companies wanted to move to produce higher oil.
So you talked about the Baker Hughes rig count. You talked about oil supply and what's in inventory. What are the 3 or 4 or 5 key metrics that you like to look at and track to evaluate this?
So, that's a really good question. I think what we've tried to do is there's so many data points in oil and energy and commodities. We've tried to filter it down into what are the handful of things that we can track that kind of tell us the true picture. So the bull case on oil is the supply side of the equation, right? You've got disruption from Russia, a major oil exporter. Russia exports about 5 million barrels a day. That's 5% of the world's oil supply. OPEC is basically telling the U.S. to, I don't know how to say it nicely, but they're basically not being helpful on that side. So if you can't fix supply, the demand destruction is where the bear case in oil could play out. And so the inventory kind of tells you the most, right? Because it's where supply and demand meet. If we're seeing demand destruction, we should see inventories stabilize or build even under a low supply environment. And so we focus on inventories. We focus on the production levels in the U.S., OPEC, and sort of Europe, Russia. And then we focus on sort of the demand side of the equation. And inventory is really where the most correlation is. So, if you see inventory start to build or accelerate, that would be quite bearish for oil.
Right. And just one thing I want to clarify for the people listening, when Raji talks about the Russian shortages being bullish, he doesn't mean for the world or for the economy. He means for oil prices.
Yes,
we just want to specify, we're not identifying that as a positive event. It just makes the price of oil go up. Also, Raji, one of the things you and I have talked about a lot lately is when there were originally sanctions on Russia, the question that I had was, okay, fine. So instead of the Russians sending their gas and oil to Germany, they'll send it to China. Whoever was sending to China will send somewhere else. It's a commodity. Who cares? And the two things that have come up on this, one, you correctly pointed out, there are supply chain issues. It's not easy to reroute millions of barrels of oil or to transport natural gas. And then I also spoke with Chris Bell, who is the national sales manager for Horizon Kinetics, another member of the Deep Knowledge Investing Board of Advisors. And he also talked about how the refineries are set up for very specific kinds of oil, for very specific grades. And so if you're not sending the oil from a particular place to a particular refinery, it's basically, it sits in barrels, but you can't get it refined. It becomes unusable. What are your thoughts on that?
Well, so you have to, I think, break it down between oil and gas. Oil is easier because if you can't pipe it, you can put it on ships or you can truck it. And Russian oil will find its way international markets. They do things like, even with sanctions, they'll mix it with oil from other countries, and then it becomes oil of unknown origin, and it's harder to sanction. But Russia relies on imports of industrial components to keep their oil industry running, and the sanctions will have an effect on it at some point. I mean, the oil will some of it will find its way to the market, but there's going to be disruption. And without foreign investment, it's hard to imagine how Russia keeps up production levels. The gas is a much bigger problem because you can only pipe it. It's not economical to truck unless you convert it into liquid natural gas, and worldwide capacity for that is quite sold out at this level. These are big projects to build LNG facilities and LNG ships and reroute all of that. So, in the short term, Russian oil is not replaceable. It cannot be replaced. You cannot, if you lose it, there's no way out of that. And it's a potential problem.
All right.
But even without the loss of Russian oil, the market's undersupplied.
Yeah. So, Raji, I want to ask you about the payment systems in 1 second. Before we do, we're getting some mixed comments in the chat on your audio. I can hear you fine. A couple other people can hear you fine. One or two people are having a little difficulty hearing you. Is there anything
Okay.
I can do to?
Is that
Oh,
better?
that's better for me. Vlada, can you just chip in and or chime in and let us know if you're hearing Raji better? I can hear you clearly, and I think a couple others can as well. But yeah, you sound louder to me. So, Raji, I want to ask you. We just saw a really interesting move by Putin to say, okay, well, if you want oil, you can't pay in dollars anymore or euros. You have to pay in rubles or Bitcoin. Over the last week, it does seem like much of the EU has capitulated, are now buying rubles, and that the ruble has strengthened against the dollar to a point right where it was or above where it was before they invaded Ukraine. Any thoughts on that?
Well, it's a fake exchange rate, so it doesn't mean anything.
Okay. Explain for people who don't follow foreign exchange. What does it mean it's a fake exchange rate?
Well, they you can't freely convert Russian currency into anything you want. So you can go to one entity, Russia, convert your currency to buy oil. They set the price. So, free markets aren't determining where the ruble trades. Russia is. But, given where oil prices have gone, the Russian economy is driven by oil. Their foreign cash flow comes from oil, and given what oil prices have done, they're having a record year in terms of capital flows into the country. So that, coupled with the currency restrictions, sets the stage for strong ruble. But it's a restricted market, so I'm not sure it means as much.
All right, that's a really interesting point. One of the things that we're seeing that concerns us a little bit, Deep Knowledge Investing is written on concerns that the way sanctions are being handled will reduce the strength and utility of the dollar as the world's reserve currency to the detriment of U.S. citizens. And so, in addition to Bitcoin and the ruble, Russia is offering to take payment in gold. China is now negotiating with Saudi Arabia to get paid in yuan or gold-backed yuan. Is there a possibility, given the amount of gold that Russia and China has, that they basically come up with some sort of hard money financial system that competes with the US dollar, particularly in the oil market, given that relations with the Saudis are deteriorating? I realize that's a really long, complicated question, but you and I know you can handle it.
I think the answer is no. I mean, honestly, theoretically, long term, these risks are there. But if you look at what's happened this year with turmoil and uncertainty and fear, the dollar's outperformed all those assets. I mean, the UUP is up tremendously while Bitcoin is down, gold is down. The Chinese have looked at this, and their internal documents suggest they don't have a solution, that they've looked at trying to do these alternative systems. It doesn't mean they won't, but I think in a period of extreme fear and political and financial uncertainty around the world, look at what the dollar's done. So it's acted like its traditional bastion of safety. But yes, all these things long term have problems. When you go after central bank assets, that raised fear among a lot of people. And China has, and it's been public, looking at alternatives and how to protect themselves from sanctions or asset seizures. But right now the dollar is the safe asset for the world, and we've seen as the crypto market has come under pressure, as equity markets have come under pressure, as the long end of the bond market has come under pressure. The dollar's actually been the outperforming asset this year. So I think it depends on your time frame. Right now, dollar is still king, but these things, incrementally and over time, definitely create an incentive structure to move away from the dollar. Part of the problem is the dollar is one of the few assets that can that's large enough to hold all these assets. Gold. Yes, you can shift all your money into gold, but you're going to end up doing it at a very high price. It just doesn't have liquidity right now that the dollar has. But yeah, over time, that's an issue.
Right, and the transportation on gold is an issue as well, unless you want to hold it in somebody else's vault. And increasingly, countries are repatriating their national gold reserves.
I've always liked the treasure chest approach.
Yeah, exactly. Right, or the Scrooge McDuck pool, another old piece of analysis. Okay, so Vlad, a great question. We're going to come back to that one. So Raji, look, we've been telling people buy oil since November. I know your portfolio is heavily weighted for exposure in that area. Let's talk to the people on the call and tell them specifically which oil stocks, what tickers we're buying, what we own, and the reason why. And let's give people a clear understanding not only of what positions we have in the space, but also help them understand the thinking and why one company instead of another. Start wherever you want.
Okay. One of the most painful lessons I've had to learn in looking at this is in the short term, the correlation between oil price and oil stocks is very high. Even if companies are cheap at a range, people talk about oil companies discounting $60, $70 oil with oil at 100. If the oil price goes down, oil stock prices go down. So in the short term, the correlations, the shorter the time frame, the higher the correlation is until you get to 1. So it almost doesn't matter what you own, depending on where oil goes. And by that I mean, if oil is going to drop $20, you're going to lose money in most oil stocks, maybe all oil stocks. If oil goes up $20 or $30, you're going to make money in oil stocks. So when you think of investing in oil stocks, you're making a commodity call whether you want to or not. It's a play on oil. And like I said in the beginning, it's an interesting opportunity today because the time frame, the supply problem is a long-lasting one. So it sets up the stage for a multi-year play in oil, right? We're not going to be able to see great production coming back. So, we lay out that framework first. And once you have that framework, the challenge that we have is for the last 20 years, as we've been growth investors. We're not 30-year commodity experts. Nobody, very few people are, because the last 20 years or 10 years have been very hard to invest in oil stocks. It's not been
right.
Unless you've been on the short side, it's been a problematic sector. So acknowledging that, is limited our universe. So when we invest in oil stocks, we're not trying to outperform other oil investors. The alpha that we're measuring is not against an oil ETF, it's against the S&P, right? We think oil stocks will make money, and we want to be in those. But where we don't dive into are some of those smaller cap, mid cap names where there's a lot of beta, and you can make multiples over the big stocks. So in that respect, because we allocate a lot of money to the sector, we're 30% of our portfolios in oil. We need a safer level or quality of company, right? We're not going to go place that kind of bet in a liquid small cap oil stocks that can double or triple. So that was the first filter that we used to take into account that expertise and that risk factor. And because of that, we focused on different things at different times. Last year, we were looking at kind of the companies with a bad balance sheet, the Occidentals, those kind of companies, Exxon, some of the integrateds, a whole host of other companies, because there was sort of a double benefit. You got the oil price improvement, which, improved your long-term DCF values, but you're also dramatically reducing leverage on the balance sheet, right? So you had risk, take Occidental, for example. And if I go on too long, let me know. But, Occidental made a horrible acquisition in Darko a few years ago. They were moving away from their portfolio of international assets in places like Africa and the Middle East. and they wanted to have a bigger exposure into American shale, which was the sort of growth market. And they borrowed $40 billion to buy Anadarko at the top of the market. And then, COVID hit and the company almost went bankrupt. So it was in financial distress with this huge gas and oil portfolio. Well, the move in oil from, the high 20s up to, last year, the $60, $70, $80 had a big impact on the company. That coupled with the new discipline we discussed, which is important. The companies weren't investing in CapEx, but in fixing their balance sheets, meant that in this period of elevated oil prices, these companies could delever materially. So you had the benefit of a higher commodity price plus a dramatically improving balance sheet. And that was our focus back then. Today, it's a little bit different. Oxy has moved a huge amount, and some of these other companies with the balance sheet problems have as well. So we've actually focused on some of the companies with already the better balance sheets and sort of, stable. So we own, we came into this year owning Exxon and Oxy. More recently, we've shifted into Exxon. Chevron, when Warren Buffett started buying it, went to a huge premium over the other guys. So we focused on the other integrateds, ConocoPhillips and Exxon. We also own EOG Resources, which, if people remember, is the old Enron. Right after they went through the bankruptcy, they reorganized. Since we've owned EOG, they've gone debt. They're now net debt free. So what happens every quarter with all this cash flow? We get this nice special dividend, right? It's like a cash cow with the exposure to oil. Exxon, could be debt free by the end of this year. And they levered up to buy a lot of nat gas assets in the U.S. And now those look quite smart, with Europe now forced to give up cheap Russian gas and import expensive American gas, through an LNG network. And ConocoPhillips as well. So again, we've stuck with the blue chips, mostly, just given our experience and the portfolio risk, and that we're making big concentrated bets. So, for us, we want to concentrate portfolio. These are 7 to 10% positions each, and being a higher quality company protects us somewhat from company specific risk. So that's been our approach there.
All right. So for people on the call, Raji, I'm going to try to sum up what you're saying. Let's make sure we're all on the same page. You're pointing out that in the oil market, when it comes to equities, there's a huge amount of correlation. Basically, higher oil prices are going to make all of the oil stocks go up. Lower oil prices are going to make all of them go down. You're playing that correlation because you're not necessarily trading in and out of these stocks on a daily basis. You have a longer term holding period, a limited number of very concentrated positions. What you want to do is participate in what we both see as a lot of upside in the oil commodity market, and limit your downside equity risk, your disaster risk. And the way you're doing that is buying a limited number of the highest quality producers, the highest quality companies available. Is that a fair summary of your strategy here?
Yes, that's right. If oil does well, there are other companies that'll do better than the portfolio companies we own, but the companies we own will do really great as well. And we don't have to worry about specific company risk, certain asset risk, geographic exposure risk, from that perspective. The other thing you have to be careful about is hedging. Not all companies are equal, right? Some companies are much more aggressive on hedging than others. So you have to be careful, because you think you're playing oil, and then you find out the company's hedged away that upside. So, and it changes dramatically. So we track it. I mean, most companies hedge some portion. Some companies hedge a lot. And you've seen companies post huge revenue and then multi-billion-dollar derivative losses on their hedges. So you have to be careful there and track that.
Right. So again, for the people on the call, I'm just going to recap what Raji's saying here. If you're going to own these companies, either, we're happy to help you. And the reason for this call is to let you know what specific companies we own. But if you're going to do the work yourself, it's really important to take a look on the balance sheet and see what kind of derivatives and swaps these companies have. Because, for example, let's say one of these companies made a deal to sell next year's production at $60. And when oil was trading at 20, that looked like a great deal. But the point is, if oil trades at 100, 120, 130, this company won't benefit from that. And what Raji's talking about is they'll have huge revenues, but offsetting gigantic derivative losses because they're capped out at $60 on their hedge. That's why it's important to look at the balance sheet. Fair description, Raji?
Yeah, I mean, I think for most people, the best way probably is an oil ETF. I mean, it's diversified, it's exposed to oil. I think when you get to company-specific level stuff, it becomes more challenging. And you're taking, again, if oil's going to work, it's all going to work. So why add a second layer of risk in terms of specific company risk?
Right. Fair enough. Okay. So you were talking about the balance sheet opportunity on Exxon, on EOG. Between the two of them, which do you think has the better balance sheet opportunity? And maybe walk people through your thinking on it, right? What's the amount of debt? How much free cash flow is there going to be? Can Exxon really get to no debt by the end of the year? What's that situation look like to you?
Well, EOG is already debt-free on a net basis. So what they've decided to do is every quarter they have the opportunity to buy back stock, pay a dividend, and they've chosen to take excess cash flow and give you a special dividend, which is kind of nice. Exxon has debt still on the balance sheet. I apologize, I don't have the numbers in front of me, but it's something in the $40 to $45 billion range, I believe. So there's still a deleveraging story there. Yeah, these guys can go debt free. I mean, they have the free cash flow generation over the next 12 to 18 months, if that's where they want to do it, would eliminate the debt. Now, Exxon pays a dividend, they buy back stock, and they, same with Conoco. So, they're not opting for that full deleveraging. It's an added benefit. I'd say today with guys like Exxon, Conoco, and EOG, it's not really a balance sheet play, but it's where an Oxy was really under financial distress, and you're going from a situation where, it was a highly distressed balance sheet to a non-distressed balance sheet. Exxon is taking off some leverage, but I wouldn't say it's a leverage play.
Okay, that's helpful. So we got an interesting question from Vlada in the comments. She wants to know if we can mention specific oil companies as well as healthy oil ETFs. So Vlada, Raji talked about Exxon, ticker is XON, EOG, ticker is EOG. He talked about ConocoPhillips. Raji, what's the ticker on? Is it COP?
COP.
COP. And then we, just so you know, we own those with him. Separately from that, I also own Texas Pacific Land Trust. The ticker there is TPL. That is a very complicated situation. It's a high upside situation, but it's far too complicated to discuss on a call of this length. And then regarding, Vlada wants to know a healthy oil ETF. Raji, is there one that you'd recommend?
XLE is the standard.
Okay, so
OIH. Okay. OIH is the service one. Now, we've talked about the exploration companies. The service side of it's complicated. Historically, they're more beta to oil than the oil companies. So if you buy Exxon and oil goes up 10%, maybe you make 10%. If you buy Halliburton or Schlumberger or National Oil Varco or Baker Hughes, you make a multiple of that. And the reason is they have operating leverage, and they're highly geared towards that. The problem today is part of the bull case is that you're not seeing investment. So where oil prices going up and the oil companies are benefiting, that's not translating into a dramatic increase in investment in oil production and exploration. So there's been this bifurcation in the market where historically oil prices go up, Halliburton's business improves, or Schlumberger does. Today that's not happening. And then if you look at the offshore companies, the offshore drillers, Transocean, Noble, those kind of guys used to really be high beta to oil. But again, nobody's drilling offshore right now. Even though technically speaking, oil's at a level where offshore, deep shore drilling is probably profitable at $60 to $70. So, the best way to play oil used to be, if you wanted beta, was you'd buy the smaller companies like a Continental Resources or one of those, Pioneer Resources. and then you buy a collection of service companies and rig companies. Today, the service side is much more tricky because part of the bull case is that you're not seeing investment in growth. And so where the fundamentals are improving for the big guys and the E&P companies, it's not really improving for the service companies. But that said, Halliburton's doubled this year. So,
right.
But going forward, it becomes tricky.
Right. All right. So Raji, I'm going to come back to you with our last question on that topic. Before we do, we got a question in the comments. We just want to type in the names of the two ETF tickers you mentioned.
XLE.
So XLE
is an E&P company. OIH is the servicers.
And OIH is the servicers. Okay. So that's now in there.
And there's probably a host of others,
but fair enough. Okay. So, Raji, I want to come back to you with the last question, but before we do that, we do have a question in the comments. And Vlada asked, is the US dollar still a good asset to buy despite the fact that it's gone up already? For how long is that sustainable? Vlada, great question. And Deep Knowledge Investing has actually been writing on this topic. It's beyond the scope of this particular webinar, but if you go to deepknowledgeinvesting.com, go to the research section. 2 days ago, we put up a piece called, is the US dollar going up in value or down? We deal with that exact issue. Please feel free, go read it. And if you have further questions, just put them in the comments there. And we're good about responding to comments. And we're going to move that conversation to the blog and the website there, and we can follow up on that in as much detail as you guys want. Raji, I'm going to come back to you, back to oil. Last question on this. So you were just talking about the danger, the issue in the servicers. At the beginning of this call, you talked about the fact that oil prices are up huge, but production isn't up. So why, right? Because technically, the higher oil prices should make these producers want to drill more, should want to make them want to produce more. Why is that not happening? Why are we not getting additional supply to match the huge increase in the price of oil?
Well, it depends. I mean, in terms of Russia, obviously the war and sanctions are the issue. OPEC is more interesting. They have targeted a 400,000 barrel increase a day quota boost, and last month I think it increased 30,000. So it's years of lack of investment in those areas. There's an argument about what the real spare capacity is for OPEC, specifically Saudi Arabia. There's been many conspiracy theories that these fields are old and production levels are tapering off, but you're not seeing it from OPEC. In the U.S., it's been a mantra shift in companies. I mean, institutional shareholders have come down very hard on companies after years and years of overproduce and then overinvest, and you're just seeing it across the board. I mean, you go through the earnings and companies saying we're not going to invest. Now, in all fairness, these companies have been under pressure, right? I mean, all the regulations are moving away from carbon. It's all in favor of green, these ESG mandates, and banks aren't lending to it, and investors don't want to own that. So, if you're not being rewarded for increasing production, and you're being rewarded for increasing the dividend, that incentive system has sort of taken hold. So it's kind of interesting. You're right. It's unusual. Historically, that's not the pattern. Oil prices going up would lead in a lagged fashion to production going up. The other thing people don't talk about is, 20 years ago, oil production in the U.S. came from traditional fields that had long lives, decade lives. Today, over half our production is shale. Shale, if you don't reinvest in shale, it typically has a 4 to 5 year cliff. So there's a shale cliff coming without this production. It's not like, the traditional fields that'll run that rate and you can maintain that rate forever with minimal capex. On shale, these things extinguish themselves. It's like a soda can. If you shake it, open it, most of it comes out, and whatever's left stays in the bottom of the can. But it happens quickly. So there's a shale cliff coming, and it's kind of scary because, the majority of the increase, we talked about U.S. at 11.5, 12 million barrels a day, and 20 years ago it was 5 or 6. That increase is shale, and if you don't keep priming the pump in terms of capex and shale, that collapses pretty quickly. So there is a shale cliff out there, which is scary. That's a longer term problem, but near term, you're right. We're heading into the interesting trade in oil today is if you don't get demand destruction, we're not seeing it at these levels, right? We thought we'd see it at 90, we thought we'd see it at 100, until wherever that level shows up. If the oil market's imbalanced and undersupplied, the oil and you can't fix supply near term. The only way to fix this is demand, right? So the oil has to clear at a price where demand contracts to a level that rebalances the oil market. And that's tough because right now we've got low inventories heading into it. I mean, this summer is going to be scary. We could have a situation of very low, catastrophic inventory levels in a lot of the distillate products like diesel, jet fuel, a host of other things. So, it's a really interesting market, and you can't really fix the supply side quickly. So, we'll see.
Yeah, agreed. I actually emailed you an article last night about there are already diesel shortages on the East Coast. It's affecting trucking. And one of the things that a lot of people don't understand is that diesel unavailability is also going to affect food production. And we've been talking and writing about coming food inflation for a long time. This is going to be an issue for people.
Yeah, it's interesting. Oil is typically not a recession play, right? So if the
Right.
economy's flowing, you don't want to be in commodities because the demand side falls apart. But there's been so much by some measure, there's been $1 trillion of underinvestment by the U.S. majors and the Western public companies over the last 10 years. I mean, think about that in terms of scale. It's very hard to fix that. And in the 70s, you had a severe recession and commodity prices went through the roof. It was supply shock. So, we're setting up for this ongoing supply shock despite a weakening economy. So, but again, the way, we're not macro economists. So we follow inventory levels closely as the clearing point. And then look at the other indicators like oil activity, drilling activity, the monthly and weekly demand statistics to make sure we're not seeing a dramatic change somewhere. But, I think, near term, inventory levels will have the biggest, be the biggest driver and correlation for oil price changes.
All right, Raji, fantastic. This has been incredibly helpful. Everyone, I want to thank Raji Khabbaz, Portfolio Manager of ArcanX and member of the Deep Knowledge Investing Board of Advisors, for your oil expertise today. Really glad you were able to talk about specific tickers, the thesis, why we like oil. For everyone who's listening, I'm invested in the same names as Raji. I find his arguments compelling, and we're invested alongside him on this. Raji, thank you so much. And for everyone who was here today, thanks for all the great questions and the participation. Appreciate it. And Raji, thanks a lot.
My pleasure, Gary. Thank you very much.
All right, everyone. We're going to disconnect. Have a great day.
Take care.